And you probably have.
Hi, everyone. Welcome to the TimingResearch.com Crowd Forecast News, episode number 263 for May 11th, 2020. My name is David Kosmitter. I am the creator of TimingResearch.com, and today we will be discussing the 346th weekly report. So if you haven't had a chance to take a look at this yet, just go to TimingResearch.com/reports, and you can get access to either the web or PDF version there. Let's see. Today, I have arranged for Michael Filighera and Neil Batho to join us as guests, and Jim, the option professor, is back to moderate, so I'm going to go ahead and turn it over to him.
Okay, great, David. Thanks a lot, and thanks for everybody to be here today. Again, probably got a pretty good size volatile week ahead of us. I think the Treasury's coming out with $3 trillion of debt, so that could cause some bumps in the debt market, and we certainly have had a big advance in stocks, so we'll have to see if we're going to keep going or it's going to roll over a bit. Today we've got Michael and Neil with us, so I'm going to have these guys introduce themselves for you guys who are not familiar. Start out with Neil. Neil, a little background on yourself and also the company you're running down there.
Thanks, Jim. So I was a broker right out of college at a big firm, lasted a year. Because it's a fun job, but it's more of a sales job. You know, I've said this many times on the show, and the brokers trained to just hold their client's hand all the way down as stocks crash. And I'm just not into that. I want to pick the stocks, So I quit that, and a couple of years later, started my newsletter service using some methodologies I actually learned as a broker, which is point and figure charting. And I think I'm one of the best in the world at point and figure charting. And I also use the Ichimoku Cloud as well, because it's, obviously you can learn it in 5 minutes instead of, the basics of point and figure. It's going to take you 5 hours. So I do that, and I send out the best picks, stocks, and options that I can for my clients.
Sounds great, Neil. And at the end of the broadcast, you'll explain to people how they can get a hold of you and find out more about what you're up to and how they could work with you. Next up is Michael. Michael, a background on yourself, and again, what's going on up at your company?
Okay. My name is Michael Filighera. I started out as a market maker, an options market maker here on the Pacific Exchange in San Francisco. I have traded here in San Francisco. I've traded on the London options market. I've traded on Amsterdam and the European Options Exchange, and also the German DTB before returning back here. Currently, with all the exchanges moving to electronic, I left the floor because there was nothing to do, and it took me a while, but I eventually just switched over from trading options to trading futures. So I've gone from being a position trader and trying to manage risk and positions, et cetera, to being a day trader, which you still have to manage risk, but it's a whole lot different in the picture. And I am the owner proprietor of LogicalSignals.com. We are very close to relaunching the website, and where I will be providing daily analysis, again, geared towards futures, but also just trading thoughts, et cetera, and that should be getting launched later this week, actually.
Okay, great. And at the end of the broadcast, again, you'll be able to tell people how to get a hold of you and find out if some of the stuff you're doing is appropriate for them.
Yes.
We're going to start out with some of the standard questions we used to use before the VIX went to 80 and the market was going up 10,000 points a day. We're now VIX under 30, and you can see the market is definitely in a more moderate range lately. So today, we're going to start with the first question is from today's opening, which was 29.15 on the S&P. We've been plus or minus 15 points off of that since then. Where do you guys think the market might end up by Friday? And we'll start out with Neil.
I'm going to go with up just because the trend is up. So I'm not going to be, an analyst thinking I can outsmart the market. They obviously knows something that we don't know. So I'm going to go with up.
You're not going to go with, I'm going to stand in front of Route 5 and hope the traffic stops before it hits me? That concept.
Well, people know me, Jim, so I'm sure they'd be stopping.
That,
You
or
know,
at
North
least they'll
Dakota
beep, they'll beep, they'll beep while they're running over you.
so.
All right. Anyway, Michael, Mike, and then we get to probabilities and all that stuff. Michael, what are you thinking? 29.15 on the open. Where do you think we end up on Friday?
Lower.
Lower. Okay. Let's go to confidence levels. Neil, confidence level.
65.
65. And Michael?
I'm going to say the same, 65.
That's 65. More likely than not, basically, that kind of number.
Well, 65 plus or minus 20, Jim.
Yeah, a little bit of a range. All right, let's look behind the curtain on why you guys think these things are going to happen. Excuse me, Neil, you're thinking it might rise by the end of the week, and what's behind that theory?
Well, I think there's just really nothing wrong with the economy at all, other than it is shut down. And it's not like the financial crisis where it took 3 years for people to get jobs. You know, some of these people, I knew people that were unemployed for years, right? And I even knew a guy, he was going to get a new job, and then got a letter in the mail saying his unemployment was going to keep going for another 6 months. So I said, screw that, I'm going to keep playing golf.
That, and he might be making more with the extra $600 than he would be making working, right?
I don't know. So there's really nothing wrong. And then the increase in the money supply is just massive, 3 trillion. Then that will eventually cause a lot of inflation that will go into stocks. And it kind of bothers me, all these analysts on TV just say, hey, we just printed 3 trillion and there's no inflation, so you don't know what you're talking about. I say, good God, man. Give it a couple years. There's going to be inflation. Why does a cheeseburger, fries, and a Coke now cost $30? It used to cost $12.95, you know? It's because of these bailouts and increase in the money supply. So,
And there's a lot of cutting going on, like cutting of jobs, cutting of this, cutting of that. And, you know, we're going to probably have a lot less restaurants. So therefore, you're going to be able to charge a little bit more if you have a restaurant. And then they're cutting the supplies of the oil. So we can probably drive off some of the supply there. And then basically that could cause higher gasoline prices. And so, you know, I think when people realize that these cuts could actually end up to be, you know, a situation for higher prices, it wouldn't be too shocking, huh?
well, I also wanted to say that people think the economy is the consumer, right? You hear that all the time. Oh, consumers this and that, and consumers are spending money. The economy is not the consumer. Economy is business to business, in my opinion. You know, how many servers is EMC building? How many cars is Tesla producing? You know, it's a lot of business to business, in my opinion.
Mm-hmm.
Unfortunately, you know, I mean, that's what's going to drive the market, I think.
And the other thing is efficiency. They're not going to need all that office space. They're not going to need all those employees. So just like after '08, where you had industries like auto and housing look like it was devastating forever. Well, you know, if you don't have as much office space and if you don't have as many employees, your costs go way down. And even with less revenue, you could get back to profitability because you've cut your overhead, right?
And you got your uncle, that's the government, with an unlimited credit card who's going to spend forever.
Yeah. And make sure
So,
that the consumer has money through helicopter money and everything else. All right. So anyway,
this is way bigger helicopter money. This is like blimp money. I don't know what to call it.
yeah, that's the, you know, that's the bull case. What's the bear case, Michael?
It's not necessarily even a bear case. It's just I'm going on the basis that the status quo, business as usual, has been shattered. And that as we push towards moving back to normalcy, we have to determine what that new normal is going to be. And right now, we have got 14.7% unemployment. Granted, it all happened very quickly, but that's still 14.7%, and that's greater than we've ever seen, even in the Great Depression, all at once. It took 3 months to get it. And so when we begin to reopen the states and the economies, people are not going to be able to just walk back into the jobs. Now, I think one of the big components that kind of got left out on Neil, and not to be critical of your statement because I don't disagree with it totally, is the moving component that's going to keep the economy going. It's going to push people out to buy cars. It's going to push people to buy the products from these companies that are paring down their offices. And all the balance of that are people, is the public. And the public has to go out with money and go to those restaurants that are going to be charging more. They may not have the choices that they have now, but they're going to have the money to go to these other restaurants. They're going to have the money to buy new cars. They're going to have the money to pay their rent and to buy new homes. So this is where I see that the problem lies, and that I don't believe that the markets or the public have factored in how difficult it's going to be to even return to a state of semi-normal. Because I don't see people just kind of jumping out and immediately just going, okay, great, let's just all jump back into things, because they're afraid. And we're already seeing that with the limited opening that we're getting, there's been an uptick in reported cases. And so I think when we put that all together, that the market, even if we want to take the premise that the market is really forecasting out 6 months from now as to what the economy will be like, I think they're way off base. And I believe that that's the part. Now, add into that the markets are not traded fundamentally or even technically that much anymore. They're quantitatively traded. And that's being run by algorithms, and we all know how they operate. So as long as everything stays the same, then I think the status quo will eventually recover and move on as always, business as usual. But being that my belief is that that's been smashed and we don't know what that new normal is, I think that the market will, we're just talking about whether it's going to be below 29.15 on Friday. That's not a whole lot. Even a pullback will bring it back down below 29.15. And that's why I said lower. Because
Yeah, I mean, obviously, you know, it's had a big run, so obviously it could have a pullback by Friday.
Yeah.
Hey,
But
Michael, I want to say while I remember, I don't know if you know about this stuff, but if you do, I would love to have someone who's in the know explain some of these things about these algos and market makers, because
right.
what I heard they do is, a lot of people think, oh, you know, they just look at patterns and buy and sell the stock, but that's not all they do. They can be short a stock. They'll put in a massive amount of bids that'll pull the stock down. At the last split second, they'll pull the bids and cover the position. Right?
To be honest with
There's
you,
a word for, is there a word for that, like splinking? Or
Yeah.
No. There's it's actually, there's a legal word, and it's actually very spoofing, isn't it? Spoofing.
Spoofing or front running, however you want to call it. And
No, front running is where you
No,
actually put an order in it again.
It's
No,
legal
I think it's
because
called spoofing, and actually there's a law against it. So I guess there is some liability to playing that game.
So they're front running it, Jim, because they're putting their buy orders in. So they're trying to front run it, and then when somebody goes down to sell it to them.
All right. Anyway, swinging back to what we were talking about, he wants to know a little bit more about algo trading and things like that. Do you have anything to add on that, Michael?
Sure. A lot of the algorithmic firms are basically, what they're doing is they turn them on in the morning, and if you're an options trader, and again, realize that there's options traded and everything on the board, everything just about. So they're going in and they're hedging their trades. So in other words, if they're going to sell premium, and that premium happens to be in calls, they're going to sell those calls, they're going to buy the stock, and that's a done trade. They take it off and they exercise it that night. So that's how they can just keep going and going and going and going. Now, granted, there's likely some algorithms that are doing exactly what Neil said. I see that. But for the most part, from the firms that I'm familiar with and that I know people that are there, they're just trading. And that's what they do every day. So they come in, they trade, they're done, they move on. And they move to the next trade. And as long as they're able to do that, there's no reason to change the program. There's no reason to make any alterations to the algorithm. So, when we saw the markets were dropping, we saw a lot of people just get me out. But I think that's also the direction of the trade. If you're a market maker and you're having to sell puts because they're coming and all holy hell, then you have to sell that put to whomever, and then you're going to hedge it by selling the underlying. And then boom. So now we got the opposite. We have a market that's going up, so people are going to buy calls, or they're selling puts. So either way, the algorithms, who are the market makers in these options and stocks, they have to take the other side. And the hedges buying.
It seems like the algos seem to just press the pain trade. In other words,
Oh,
when the
absolutely.
markets are rolling over and they can see that there's no bids, obviously they like to sell and press that side. Since every Tom, Dick, and Harry was negative on the market, then obviously the selling has dried up. And so they're going to press the buy side. And now they've got a situation where they've looked behind the curtain on these numbers that look horrific, and they can see that behind the curtain, these numbers are really not that horrific for business, meaning 14.7% unemployment, but 90% of it is either high school grads or didn't finish high school. College grads, only 8%. And then the income hit to the economy, only 10%. And you got the Fed replacing that with unemployment benefits plus $600. So you're not getting much of an income hit on the economy, and the guys who lost their job wasn't making any money anyway, and they're not going to get called back, and they're not, and with Zoom and everything else, they're not going to use as much of this stuff. So you're going to possibly get a very big earnings recovery that's going to shock people, because these guys, slashed costs, and they're using things like cloud to replace people. And if the earnings recover fast, even if they have less revenue, just like in '08, you're going to see earnings surprise people, and that's what these people are now betting on. Because as soon as we got above 2,800, it's kind of a green light on stocks unless they can get it back under 2,800.
All I know, Jim, is that since I started talking, the Dow's up 50 points. So.
Yeah, well, why wouldn't it be? Why wouldn't it be? They're going to have no employees to bring back because they're all using the freaking internet and technology, and they're not going to be flying all over the country. They're going to have Zoom, and so their profitability is going to come back so much faster than people believe. And the people that are unemployed, sad to say, it's an indictment on income inequality. But the less educated and the lower cost and the lower revenue people are the ones who lost their job, which is not going to affect these companies that badly because of the fact that the Fed has replaced that income in the economy with unemployment plus $600.
No,
I just
Jim,
thought of something, Jim.
I'm sorry, guys. I have to disagree with what you're saying, Jim. Strongly disagree.
Well, I mean, I'm just talking. Do you know that the high school and non-high school percentage of the unemployment rate is outstandingly large, correct?
I want to tell you,
you don't know that.
I'm not saying I don't know it, Jim. I'm saying that I don't agree with that analysis.
Okay, but I mean the facts that I talked about as far as who's unemployed and also how much income was lost by the economy through this unemployment rate. I guess what I'm trying to say is it could shock people that you could have a 15 to 20% unemployment rate and new highs on the S&P.
So, Jim, are you saying that the people that are mostly unemployed are people that only have high school diploma?
I'm saying high school or no high school, and that their income wasn't very large because the hit to our national income has only been 10%. And this is right off the statistics. This isn't coming out of,
like white collar people have not lost their jobs.
8%.
Okay. See, I didn't really think of that too much.
Yeah. Well, I mean, that's what, you got to figure, listen, at the end of the day, are they going to earn money or are they not going to earn money? Now, if obviously it's 14% of people who are making 150 grand a year, they're not going to earn the money because there's nobody who's going to spend money. Because
so their salaries are less, so it doesn't hit as hard, right?
That's right.
That makes a lot of sense. See, that's what the market knew, and I didn't know.
Yeah, and also, and that 10% was easily made up by the amount of money they threw at unemployment plus $600.
Yeah, easy. Yeah.
And that's why your buddy wants to play golf, because he's making, 25, 30 grand by not working, and maybe he was making 20 grand while working, whatever.
Yeah, he's pretty lazy, that guy too.
Yeah, well, believe me, he's not in a party of one.
He's a good golfer.
Yeah, I mean, but and then again, some of these jobs that have to do with high density people, they're not going to come right back because you're not going to have high density situations possibly, right?
Can I just toss in something here?
Sure. I'm going to quit my service and do a course on how to.
I live in San Francisco.
Right.
Uber, Google, Apple, Facebook, they're all people go.
They're what?
Now, these are people that are making $250,000 or more. So whoever put that number together about the unemployment numbers, we're talking many people are getting laid off. So the percentages,
Well, that's where the 8% comes in. You get it?
sure
8%
I
of the
get it, but I
people. Yeah.
don't get that somebody is saying, well, the market's going up because the poor people don't have any money to spend anyway.
Well, I mean, I don't think they're calling them poor people. They're calling them not high earners. And obviously, all the restaurant, you take all the restaurant workers, who are working on tips and minimum wage.
Yeah, I mean, I'm fine. I just disagree with what you said.
Yeah. Well, I'm just working off statistics that are
I
out there.
disagree with what you said.
Yeah, no. Again, I hear you. Anyway, the market's going up every day, so obviously somebody's buying it, and it's not just because Santa Claus is buying it, right? So there's got to be a reason why people are buying it, not
I don't
just
think
algos. It's not just algos, because there's things called money flows going into ETFs, and I don't think ETFs are being used by algos. Correct?
That could be.
Anyway, so we got a situation where we got up or down by the end of the week, and then we've got a situation where, the bull case is don't fight the tape, and the bear tape is we've come a little bit too far. We could have a pullback, very legitimate, and on a longer term basis, the consumer, under the idea that they are, not going to get their money and they're not going to be out there spending any money, is going to be problematic for the economy. Both views could happen because nobody knows exactly what the future holds, right? So with regards to other factors, let's go over other factors, Neil, that you see longer term that might be, or you have any themes or any type of things like that you'd like to talk about here as far as the longer term?
Yeah, if you're going to go into college, get a job in biotech, I guess, because that's going to be real hot for the next decade.
Mm-hmm.
Getting venture capital money for people that want the next cure to whatever it is. I mean, that's what's leading the NASDAQ. I mean, I'm looking at a triple leverage that I used to trade quite a bit. The low is 13 LABU. Now it's at 49. This is from the bottom. So a triple off the bottom. Well, basically, biotechs have doubled off the bottom, on one-to-one leverage. It's the leading sector. I think biotech's going to be real hot, mainly because they're going to be able to raise a lot of venture capital.
Right.
I would also go into venture capital if someone's looking for a career. They're young.
Do you like to look at that IBB as a broad-based thing, or do you like to go pick them?
Yeah, no, I like IBB.
Yeah. And today it's up another almost 4%. And from the 52-week low, it's come from 92 to 133. So it certainly has got a pretty good legs there.
I mean, it's way past the highs of the year. The
Yeah.
high of the year was like 123. It's at 133.
Yeah, today it just made a new 52-week high, actually. Didn't
Yeah.
it?
Yeah. So.
Anything else on the radar besides the biotech area?
Oh, do you want my stock pick?
No, just generally they could call you to get your specific stuff.
Yeah, my favorites my favorite is semiconductors, because I don't believe you can have a real bull market without semiconductors, because they run everything, It's not like the old oil and gold bull market from the early to mid 2000s. So semiconductors are good. Biotech is good. Those are the main things I'm looking at. I was also doing some trades on the indices as well, leverage trades, because sometimes you just throw in a towel for stock picking and you go with the index.
What do you think of TLT? It looks like it blew off to me at 180, and it looks like it's over.
I would definitely not be in bonds now.
I've
traded bonds many times. You can get over 100% on options on bonds. We've done it, I think, 3 times in about the last 15 months.
Right.
But now it's over, man, because bonds put in this huge 20% premium as the market's crashed, and now they don't need that premium anymore. So there's just no reason, and you can't cut rates anymore. So where are bonds going to go? Nowhere. So
and there's about a 2% spread on on investment grade versus the Treasury. So you've got J.P. Morgan and you've got Berkshire Hathaway and people like that trading on long bonds at about 3.5% or better. And 3.5%, if this thing falls further and the 10-year goes to or the 30-year goes to 2% or better, you could be getting 4%, 4.5% on things like JP Morgan, Berkshire Hathaway, and Bank of America and stuff like that. So
I see. So you're saying that corporate bonds will sell off more than these bonds?
no, they'll just keep that 2% differential. So like if treasuries are paying 2, then you get 4. And if treasuries went to 2.5, you get 4.5, that kind of thing.
Got something cool on my system now that I didn't do before is I have all the government bonds,
Uh-huh.
the 10, the 5, the 2, and then I have all the yields, 30, 10, 5, 2, and 3-month yield. And so I can just look at it every day and see how that yield curve is doing,
Mm-hmm.
And then I'll say, "Ooh, it looks like it might be inverting just a tiny bit, little bit." And I'll look at the market. Sure enough, the market will be down on the day, and it's really good. I'm just going to tell everyone what these yields are because people probably don't know. Okay, 30-year yield is 1.42%, 10-year 0.7, 5-year 0.34, 2-year 0.17%, and the 3-month 0.11%.
Yeah, so the Fed's controlling the front end, and that's why the rates are at 0. And the plan there is to force everybody into risk assets. And that was the plan after '08, and that was the plan for 10 years after '08. And now
Sure.
they're back to the plan. Yeah, it's a
Well, I
shame
got a
because
copy of the
if you
yield.
save
Get a
money,
copy of it?
you're penalized if you save money and you want to be conservative because you just can't do it.
I still
Because
kept my fax number from the 80s just so I could get these plans.
yeah. Well, let's turn over to Michael real quick. And Michael, again, you're working with shorter term trading, intraday trading, so you're keeping things on a relatively short time frame, obviously. And so these grandiose concepts about 6 months and a year and things like that are really not that important to the way you're trading, obviously. The other thing is there are other things besides these things we're talking about. So, what are some of the things on a thematic basis that you're looking at to trade? Any certain sectors, any types of things? And one last question is Tudor Jones, I think, took about 2% of his assets, I guess, and started going into Bitcoin. Do you use futures on that or GBTC, or what do you use to get involved with
There
that?
are features on the Bitcoin, but I don't touch them because they're too thin, and so they just move quickly and yeah.
Yeah,
So I
and they
don't
can gap on you,
have
you mean?
any interest really in Bitcoin. As far as that goes, I'd rather be in gold than Bitcoin. But I want to make something clear. I am not bearish, nor am I really bullish. And where I'm coming from and speaking to a longer term picture is that in my view, in my opinion, the status quo has been crushed. So what we base opinion on and what we think, because that's the way it happened and that's what we did before, that's where I think the change is going to come. Because there is not any way we can move back to normal. We cannot go back to the way it was in January or even February.
Michael, I live in the 1980s pretty much every day, man. So I don't know.
Well, that's true, but my point is, it's like until we actually can experience people that have lived through a pandemic, which
Yeah.
there aren't any anymore because they've all died, because 1918 was a long time ago, then how do we really start to base ourselves on how are we going to get people back to work? How are we going to restart the economy? So,
Well, again, you may not have to get everybody back to work, and you may not start the economy at the same speed. But if the companies have a lot less overhead, then less revenue can still be profitable for them because they didn't bring all those people back, and they're using Zoom rather than the Marriott meeting
how
room.
are they going to
That's, I
sell
mean,
their
I'm just trying to tell you, that's the theory, because people are not buying all this stock because they're nice guys. They're buying it because they believe in something,
You keep cutting me off and not letting me finish.
No, I'm just was finishing my statement. That's all.
I disagree with that statement.
Okay.
Because companies, who are they going to sell their product to? Yeah, they got less overhead. Good. Who's going to buy it? Who's going to buy iPhones?
I'll buy something. I got money.
Oh, good. You're one person. Did you support
Neil, do you have any money?
last quarter?
Neil, do you have any money?
Yeah, Jim, you realize that this is being recorded, right?
No, I'm only kidding. I'm just saying is that he's saying that people don't have the money. And what I'm trying to say is that maybe people, I mean, they may not. The whole story, Michael, that you're saying that things will turn very badly when the consumer cannot support the economy, then you're looking at a situation where the thing will roll over and it will go south and if of course the virus comes back, like I'm sure you're thinking and I'm thinking as well, that's a big risk to this market.
That's right.
You
So
know,
start
and
out
so I mean, hey, listen, don't kid yourself. There is some things out there like the
right. So I
virus
know
comes
that
back.
the people were prepared and not just openly believing that it's all rosy.
Exactly. No, I agree with
So
you
I gotta
100%.
I gotta get in here on this
Yeah,
virus,
sure.
because I read something that in New York City, 25% of people already have the antibodies to the virus. They've already been infected. Their immune system already took care of it. And there have to be millions and millions and millions of Americans that are infected and don't even know.
Right.
And
Yeah.
so, you're going to
And
hit, it's almost inevitable that probably half the people, by the time this is all over, half the people are going to have these antibodies.
Right.
And unfortunately, this is happening to a lot of the elderly people, so that's, and the average American, it's not a major threat to them,
Right.
uh,
well, I think that that's kind of not,
back
that's
in, there was another one
a
back in
bad way to
1957,
think,
which also
because
been bad.
what they're also stating is even though you may show up having antibodies, they don't know if you can be reinfected or not.
Yeah,
They don't know.
yeah.
And that's the part that everybody's going to run on. Well, they got this over here and they're
Yeah.
doing that. Well, this over here and they're doing that. So this is all positive. It's like, no, we don't know yet. And the market is moving forward because of what I think is like, well, jump in. I mean, that's fine. I'll play along with you.
Right.
But I think if you're going to try to give somebody advice or give somebody some insight as to a long-term picture, it's up in the air.
Yeah. You have to put weight on both. You have to put weight to be balanced. You have to put weight on both scenarios.
Yeah, I agree.
All right, let's go to the stuff that you really do like to watch and everything, and also are active in. Let's talk about the gold and the silver and see how you feel there, and maybe give us some ideas on what you're looking at.
Well, in gold, I want to put up that chart, so bear with me while I change that. I think gold has had a tremendous run, as you can see now, at least on this hourly chart. It's just moving sideways.
Right.
Because the market, I believe, intends to really go up and break above the most recent highs and keep going. But it has to go through a consolidation phase. And you can see all these lines, those are all moving averages. And they have a big thing to say and where prices go and how they move and where they meet resistance and where they'll find support. I think the gold is just biding its time. But I remain longer term bullish on gold. But for varied reasons, which we really don't have the time to really go into here, nor it's not the correct platform. But I think that right now, unless you're looking at gold as a very long-term investment and you're buying it for asset protection versus anything else, then I think just stay away from it. What I do like in the market is the fact that volatility, while declining, continues to produce some very solid moves across the board in gold, in crude, in the equity indexes, et cetera. And that's really where I feel traders need to focus and play, because there's still a lot of trading to be done. There's still a lot of buying and selling to be done. So depending on what your instrument is and depending on what you really want to get out of that, I believe there's a lot of play going in both directions. And that's why I kind of shifted and went to day trading. So while I still like gold, I'll only play the day because I'm playing the volatility. So
And the chart shows you've had good volatility too. It seems like you've been,
absolutely.
1675 up to 1750, and you've had some meandering, and you like to go home pretty much flat every day so that you don't have any overnight risk. Is that pretty much what you're doing?
Yes, I mean I have a core position, and then that remains a core position, and that one then I will balance against the short-term moves by just using puts. So, because I'm long physical, and so I'm just going to balance it out with puts so that I
Now,
can.
on the physical front, I was going to ask you how you feel because the American Eagles supposedly have like almost $150 premium over spot.
I
Do
know.
you? They don't anymore?
No, I said I know they
Oh,
do.
yeah. So that makes the physical a little bit of a rough racket, and maybe makes the futures contract a little bit more reasonable, right?
Yeah, actually it does. But again, depending on where, I think the demand is still high, which is why the premium is there. But it goes with what's happening in the market. I think people are going to want to pay more premium if they're watching this volatility in gold,
Hmm.
even though it might slide down. Now it's like today it's below 1700, but the other day I saw it go below 1700, and by the end of the day it was up 50. So what is somebody's, I don't know what makes somebody want to come in and just really pump it and buy it all the way back up. But I think that if your goal is to own gold, what those people are paying the $150 over,
Yeah.
no problem. No problem.
I think it's because the people are hoarding the coins now because the prices are firm. So obviously, they work as dealers, and if there's nobody out there dealing in the coin because they've been hoarded, it would put the
Right.
premium high, right?
Right. Oh, no, you're exactly right. Yeah, I agree.
Now, one question for you is obviously the U.S. dollar has something to do with the gold, and the U.S. dollar has been very firm around this the dollar index, right around the 100 level.
Yeah.
And what's your feeling on the U.S. dollar? What might happen there?
I actually think the U.S. dollar will firm. I think as the perception is that we're stabilizing, and the perception is that we've got a handle on all this, then I think that the dollar will come back. But if I have to balance that against every pair that it trades in, it's all going to come down to interest rates. It's all going to come down to what we're really doing with interest rates, what the world is doing with interest rates, and how they want to play that against each other. But right now, I see that gold pays attention to it, but then I watch a day and I'm like, oh, you guys are surprising me today. Because maybe the euro is doing something. And we know that gold gets priced in everything else as well. Or it just depends on who needs it on that particular day. Right?
Your point on consolidation makes a lot of sense because I look at some of the longer term averages, like 2 and 3 years out, and they're in the 1400 area or something like that, and even I think the 200-day is down around 1600 or something. So it's probably meandering to kind of let these moving averages catch up to the price, maybe, huh?
Yeah, I would not disagree with you.
The other thing on the S&P, the stocks that might help the gold if it happens, is the S&P's had a throwback of about 61% when we get up to this 2780 area. So if it can't take out this 80 area, it is very possible that there could be a report on the headline saying that the restart is not going well, or like you say, or anybody says, the cases jump up, and we've come a long way. What did we come up? 750 S&P points in a month and a half, and like you were saying, it could be discounting a little bit too rosy of a future.
And truly, I don't have any push in either direction in terms of like what or how people should trade. I think that if they need to base it on their information versus I'm afraid I'm going to miss a rally,
right?
And I got to get reinvested, and so that's why I think it's like the necessity to really just put all the real factors in. It's like if you put all that together and you're still coming out, I'm going to buy this. God bless you. But I have found that most people don't, and then they're looking for someone to blame, so to speak. And that's why I still think we're going to have a correction because I'm looking at my overbought oversold. This is an hourly chart that's showing, and you can see that it's kind of gone from this morning being extremely no momentum or downside momentum, and stochastic wise it was oversold, and bam. So as soon as I saw that, I just turned around and bought it this morning. It's like, why wouldn't I? And then what happened since? I got 1, 2, 3, 4, 5 hours of up bars. And so, you know, if you got in early enough this morning, pretty much right after the opening, you're sitting fabulous at the moment.
What about silver? That's been lagging. It can't get above
Silver has
1650.
been lagging, and I've not really read up on it. I haven't traded silver in years,
Okay.
and so I basically haven't even gone in to look at it. But I saw an article that was talking about why silver was lagging. Of course, I don't know the details of that article, but I think there are specific reasons, and I'm not real firm on it. But like yourself, I am surprised that it is not trending more in line with gold in terms of percentage moves. But that's the case right now.
Yeah.
I mean, stocks that I like, I continue to love Amazon, but God, it's trading at $2,415.
Yeah.
Who can go out there and go scoop out, 1,000 shares of Amazon? There are people, and like Neil mentioned, I think the semiconductors are important, and I continue to really like advanced micro devices. And even as something to be long when the markets turn and go down, because I do see a recovery, and I do see that computers are going to still be made, and chips are still going to be needed. So I like advanced micro devices. I continue to really like Apple. Apple's got a ton of cash.
Mm-hmm.
Apple's going to be able to sit this sucker out way longer than the rest of us. But that doesn't mean that Apple won't be reflected if we turn lower.
Mm-hmm.
So, and this is something else that I really want to add. Even if the market turned and went down 3,000 tomorrow, it doesn't mean that Apple's a bad company.
Oh, no.
It doesn't mean that any of these are a bad company.
Right.
It basically means that we got ahead of ourselves.
Yeah.
You
And
know?
then, listen, that's a distinct possibility. Neil, a lot of the momentum things, obviously have been working because, like Michael's saying, we're not going to go back to normal, but the new normal will probably have a lot of technology in it because people have found out that they can use technology and then cut their costs. And believe me, when you get that combination, people run to you. So obviously the tech sector and the semis and the other ones that you're kind of interested in are the beneficiaries of that transformation. So that makes a lot of sense.
Yeah.
With regards, Neil, to SILJ, that was something, that had a big rally and you were kind of into that at that point. Do you have a feeling on SILJ anymore? It seems to be having a tough time at $10 a share. Is there anything you feel on that, or?
I don't remember that pick, Jim. I just brought it up now. What is this?
SILJ?
It says ETF.
Yeah, when it was, I think, well, maybe I'm wrong, but when it was way down, in the 5 area, 6 area, you thought there would be a run. And
what is this stock though? It says ETF Managers Trust. I don't know what that is.
yeah, it's a silver junior miners.
Oh,
SILJ.
okay, yeah.
I just, maybe I'm wrong, but I could have sworn you were here once, and when it
No,
was.
I wish you would have told me about it because I didn't know with silver junior miners. I thought it was really hard to find silver pure play miners.
But do you have any feeling for the metals at all, or are you kind of not focused on that sector too much? Or
we had our best trade in the last 3 months on that silver rebound. We got 42% in 2 days on that triple silver ETF because it was awesome. So
I guess that's what I was thinking. I made a mistake on the actual symbol. But do you think it's a little stalled out here, or how do you feel?
I mean, I don't think gold's going to go above $2,000 an ounce unless there's another $3,000 to $4,000 stimulus bill.
Right.
Because my hypothesis is that the gold and silver prices run on deficit the growth of deficits, like the forecasted growth of deficits. That's why when a war starts, you have to buy gold. It's the only thing you need to buy because you don't know how long the war is going to go on, and they're going to spend more and more money every year on the war, just like they did starting in 2003 when gold went from 350 all the way up to, what was it, 1800. you know, and then even as the deficit keeps growing, but it grows at a slower rate, then that's when you get out of gold. And so now this is like a one-shot deal, you know, and gold is an inflation play. And the reason gold is an inflation play, because it's either war or socialism. Those are the things that cause inflation,
Right.
right? So, I mean, I'm not an analyst by any means on the Middle East, but it appears that Trump is trying to have some peace in the Middle East.
Mm-hmm.
And that's, you know, gold that will, if you're a trader for gold, that's bad for gold, good for peace. And the only other reason now that gold would go up is socialism. So if you have a guy like Biden who's going to say, you know what, part of my platform is going to be a universal basic income of 30,000, and he's leading in the polls, you better freaking buy gold. You know?
Do you have any feelings on the catch-up trades, meaning the sectors that are out of favor, which would be your value stocks or your industrials or your materials or, you know,
like
home builders,
bottom.
airlines?
Yeah, I really like home builders. Some of these home builders are up 100%. And I was just looking at the lumber futures as we were talking. It's going to take me a little bit to find it on my list here because I got a really big list. But lumber futures just broke out today. So they are at a high from the bottom. And that's obviously means that people are going to build houses. And that was sort of my theory a couple months ago, that it's really going to be housing that's really going to get us out of this. What the government has to do is they have to get millennials into houses. Otherwise, the millennials are going to get really mad. And there's millions and millions of them. And the only way for them to get them into houses is they got to relax the lending laws even more, with the threat of another 2008 crisis. And I think the 30-year mortgage rate is going to go down to 2.75%. And I just checked it. The lowest one today is 3.12%. I saw. So, yeah, no, housing is going to be big, and the government's going to keep the rates low for many, many, many years, and they're going to get housing to bail us out once again. And so one of the best investments you can make is you get a home equity line of credit, you use it as a down payment on another house, and you rent the house out to a bunch of college kids. And that's your retirement, not the market. Because if I look at the Dow, I did a calculation, the Dow has averaged 3.3% compounded return since the peak in 2000 until now. You think you're going to retire on that? There's no chance.
And you think some of these houses could even rent out at positive cash flow if the numbers crunched out right, huh?
Yeah, maybe. And you know what? It's a leverage game. So the biggest leverage game you can play is the house, because you're putting it down to 5% down payment. That's a 20 times leverage trade, right? You're not doing that in the market.
Right.
Yeah. So, I mean, you can do these kinds of things. You can get, just do what you can and play the leveraged game. I mean, this isn't like it was back in the 80s or 90s when interest rates were 5% and it was harder to do these kind of things now. But, you know, in 10 years, some house prices, like if you can get something for around 400 in 10 years, that's going for 650, 750, right? Maybe it's not a real profit because we're talking about inflation and real dollars, but guess what? Rent always goes up. It always goes up. So even
And there's always going to be a group who don't have the down payment or for whatever reason can't get in there, so they're going to need to rent, right?
College towns are my favorite. You're always going to have someone to rent your house.
Right.
You know, I mean, even if it's not positive cash flow at the beginning, it doesn't matter because it will turn positive cash flow, because in the end, rent goes up. And if you're charging $1,500 a rent now, in 20, 30 years, you will be charging $3,500, even $4,000 rent, and the house will be paid for, and that will be your cash cow for retirement.
Yeah. It's a plan. It's a plan.
It's a game.
Michael,
it's a game. You can play the game, you know?
Yeah. And like I say, there's variables to the game you don't know, but it's a plan, and it definitely has has some things that could work for it. Michael, let's spend a few minutes so you can explain a little bit more about some of the markets you're kind of focused on and some of the things that when people contact you, you're going to be able to help them with.
Okay. I focus on futures. And my primary, I tend to stay away from the Forex pairs and also the Forex futures. But they are extremely liquid, and I know people love to trade them. But I focus on crude oil, S&P, gold, the NASDAQ, the Russell, and the Dow. At times, I will add bonds, but because of the size of the contract, it really excludes a lot of people because it's such a huge contract, and it's $31.25 a tick. And what I'm basically doing is that I've set up my charts, and as you can see here, just even on this daily chart of silver, and if you hold on, well, I'm going to use this one. And this is an ETF, but you can see this, everything is kind of conjugating right here. Those are moving averages. That's, 4-day, an 8-day, I got the 100, I've got the 20-day. Now, the different moving averages are in here. So if I'm looking at this on a daily basis, I'm going to say, you know what, it's starting to break down below the more important intraday moving averages, and it's getting ready to break down below this blue line, which is the 200-day on a daily basis, okay? So the daily chart. And it's going to change positions if I go down to a small chart, or if I move myself up to a larger chart, it really starts to change position. And then this is the 50-day. And if I had to just make a call right off the bat, I'm going to say that this index or this ETF is likely going to come down and at least test the 100 and test, excuse me, this is the 200, the purple one. This blue one, I'm sorry to say that's the 8-day. This purple one, and then this orange one is the 50-day moving average. And you can see that the 200 moved above the 50, which is a little strange, but it happens. And markets tend to, when they pull back, they head for moving averages. So I'm saying minimal, we're going to come down 922, maybe even as low as 888-ish. And if it breaks below that, then it's good night nurse. But if it holds, then I would expect a rally. Then I go and I look at my patterns. And I see if the pattern is going to support a drop and an additional rally, or is it really looking like it's just going to pull back even more, maybe down into this level. And so as things progress, you can update your own picture. Now, I have to take this from a daily and I put it on a 2-minute chart. So you can trade on a 1-minute, a 2-minute, a 5-minute. But it's the same basis as they start to break moving averages. That's going to give you signals, either to buy or sell. And understand that if you're trading on a 1 or a 2-minute chart, your picture changes that quickly. So the opportunities are numerous. And so what we're trying to do is it's like we want to figure out real quickly, is this a trade we're going to hold because now we're looking for it, it broke and now it's going to go to a different level, or it broke higher and it's going to go up to its next resistance level. So we've got all those factors in play, and that changes and happens daily, and it happens even intraday. You also throw in a footprint chart, which is basically going to show you what and how much are they aggressive sellers, aggressive buyers. And so there's a lot of factors that go into day trading, and that's what I'm teaching and hopefully using constructively to help other people to make money.
Yeah.
And that's the name of the game.
There's a lot of information that you've got there, no doubt, huh?
Yes. And the thing is, it's like, you don't have to be 100% proficient, but you really have to kind of understand what makes or breaks different trades. And that also understand that we're not the only ones out there doing it.
Mm-hmm. Right.
You know, there is so much interest in the market. And now, as we very astutely have pointed out, there are many, many people there. They are at home. They're not going into an office. So they can put up a chart. They can trade. That's all they can do. And so their intensity on wanting to buy more, or they want to make more money, let's just say.
Yeah.
They have a desire to make more money because they have to support the family, whatever. So we're getting a lot of people that are coming on.
Yeah.
And
They say retail investors are really picked up their skipping their step because they have the time to do trading now, huh?
yeah. And
I was going to ask one quick question, if I could, of Neil. Neil, with the few minutes here we've got left, is there anything that you could add as far as some of the things people can pick up when they contact you on things that you're going to be bringing to the table? You did mention the point and figure and the cloud. Was there other things you wanted to mention that would be available to people?
Can you hear me now?
Yeah.
I just wanted to talk about a comment I saw on the screen there about rent and inflation. Is people don't seem to understand the power of inflation and even comprehend how much of an effect that can have over 20 years. If you have 5% inflation, and for the last 10 years, we've been going at 5 to 7% inflation on food, rent, and the basic things in life, right? That's 2.65% over 20 years. And so, I mean, I think about a lunch that I had 20 years ago at the same restaurant is twice the price now over 20 years, right? So, I mean, I guess I'm getting a deal, right? And so in another 20 years, just to get some fast food, on the side of the street, could cost you $30 for 2 hot dogs and a Coke. People don't seem to think that's possible because maybe you're 25 or 30 years old. You don't remember because you don't remember money since you were 15. But inflation is real and it's absolutely massive. And with these low interest rates, I mean, how many people ever thought an average house is going to cost $1 million in the 1980s? Nobody thought that, right? But I mean, it can be very normal 40 years from now that a house could cost $10 million. And that's just fact. And you got to realize that. And that's why, my big plays are playing the inflation game. And the inflation game right now is stocks. And it's not going to be gold unless,
the system seems to be built on inflating assets. There's proof of that, right?
Yeah. It's not like the old days where, I mean, we have been in a 40-year negative interest rate environment since Reagan was elected. How many people even remember seeing Reagan on TV? I don't. I wasn't old enough, right? So, I mean, where are we going to go from now? Nowhere, really. I mean, rates can barely go up. And so in the old days, the government needed money. Well, they got to tax you. Well, now they just print and pay for inflation.
And the other thing is they made a comment, Neil, that even with the increase in the deficit, the servicing of that amount of money to service it is less than it was before because of low interest.
I did a calculation, actually, Jim.
Yeah.
If I calculate 100 million working Americans,
right,
this bailout will cost everyone $75 a year.
Exactly. Yeah. And that's why they can re-leverage.
Forever.
Right. And that's the story, really, at the end of the day, is re-leveraging. And then, as Michael says, at some point, if you re-leverage to an excessive amount, those metals will go up because gold got to 1,700 from $300 in 03 for a reason, right?
Yeah.
So that's another example of the price of the prices going higher and the prices of things going higher because gold is kind of keeping up with that thing, right?
Do some calculations by yourself on a calculator. Do 5% compounded inflation for 40 years and see what your lunch is going to cost you. And then in 40 years, remember this call. You'll say, I can't believe it happened.
Well, Michael, why don't you again give everybody a little quick reminder of who you are and how to get a hold of you and anything special you want to offer.
People that want to get a hold of me, please send me an email, and you can send it to michael@logicalsignals.com. And in that email, I am going to be restarting my services, and that is basically providing analysis and commentary on the markets each day. If you send me an email at michael@logicalsignals.com, I'll get it, and I'll include you on a 1 week free trial, which I want to be offering. And so as long as I have you on my my list, I will be sure that people can take advantage of that 1 week free trial, and then see if that is going to be something for them. Again, on the website, I'll be providing commentary and analysis based around the futures, based around how things are trading, why it's trading, and different areas that we're doing well in, or different areas that are providing problems, et cetera. But I just want to provide a realistic view of what's happening on a day-to-day basis within the markets. And I'm going to leave it at that.
Sure. And Neil, real quick, how do we get a hold of you there to find out what you're doing and how they could possibly take advantage of that?
Sure, Jim. Just go to traderreview.net and sign up, and I have a free newsletter where I give away a lot of the big calls. So I told everyone to get out of this market on January 24th for the first time in 10 years. I said, sell your 401ks, sell it all. And, I got an email from some people that weren't happy about that. But I give the big calls in the newsletter, and I give the exact picks to private members, but a lot of value in the newsletter that I give out.
Okay, sounds good, guys. And of course, thanks a lot, Michael, for being here, as well as Neil. And hope everybody learned a little bit of something and can learn more about what these guys can provide for you by contacting them. I do have a weekly update that I send out each week on my views, my opinions, my observations. And if you'd like to get that free of charge, just email optionprofessor@gmail.com and we can put you in the queue. Right now, I'm sending it back over to David Kosmitter. And thanks a lot, guys, for being here.
Thank you.
Thanks, guys. Exciting discussion today. So just a quick reminder to everyone, be sure to subscribe to Timing Research on YouTube and your favorite podcast directory or app or site. You can also go to TimingResearch.com to get access to the recording of this show as soon as I can get it posted, or any of the past shows. And also be sure to mark your calendars for next week, May 19th, 20th, and 21st, putting together another Synergy Traders event where, so Tuesday is going to be all stock and options presentations. Wednesday is going to be all Forex presentations, and Thursday, the 21st, is going to be all futures presentations. And actually, Jim is going to do a presentation on the options day, and Michael will be here to do a presentation on the futures day. So I'll be sending out more information and schedule and that sort of thing on that soon, so be sure to watch your email. Also, you can get access to all the live events at TimingResearch.com/live for that. And just want to thank my guests again for today: Neil Batho of TraderReview.net, Michael Filighera of LogicalSignals.com, and Jim, the Option Professor, at OptionProfessor.com. Thanks, everyone.
Thanks, David.